The top 7 monthly ETF funds under the radar with no NAV erosion and total returns.
Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today, when most investors think of monthly paying ETFs, they immediately jump to the biggest names and, of course, normally the highest yields. But there's the problem. High yield does not automatically mean strong performance. In many cases, it comes with NAV erosion and quietly eats away at your long-term results. So today we're doing something unique and different. We're looking at 7 monthly paying ETFs that fly underneath the radar. Now, these are going to be some funds that you probably never heard of or never even seen or talked about. These funds pay monthly. They show better NAV stability than the headline income ETFs, and they deliver competitive total return. And always know, total return is the real answer of what we're looking for. So it's not just cash flow, it's giving you a total, a little bit of growth, a little bit of return across the board to give you what you want. Now, of course, this video is for educational only, and it's not financial advice, as I'm not a financial advisor. So before we get in the video, I got to do a shout out to all of our Patreon supporters. Thank you so much for everything that you do. If you are not part of our Patreon, don't be afraid to hit that. Down in the description below, you'll see a link for the Patreon. You can join for free. Also, we want to say thank you to all of our YouTube members. Those are the guys who pay a little bit to support the channel. We appreciate you. And then if you're not a subscriber, don't be afraid to hit that bell notification and that subscribe button. We'd love to have you part of the family. Let's get into today's video of the 7 monthly ETFs that are falling underneath the radar.
What under the radar means? Under the radar refers to ETFs overlooked due to the moderate yields, but offering superior structural durability and long-term total return potential. Moderate yields are not designed to win the yield race, but balance the income sustainably. NAV stability. We don't have to really worry about that. The NAV erosion, we're trying to find something that will prioritize, preserve the capital, and maintain consistent NAV performance over time. Definitely monthly distributions to have that regular potential of income. And total return over yield. As we've talked many a times, total return is the real hardcore component of any ETF fund. So we're not yield chasing with these. What we're looking for is total returns that will give us our best across the board. We rate it this way. The first one is asset health. How strong is the actual ETF? Number 2 is the NAV stability. And number 3, the total return. And we're going to go through each and every one of these. Our first fund, SLVO, the UBS E-Track Silver Flow. Now, this one flies underneath the radar because it's not an equity ETF. It doesn't track a major index. Most investors ignore it unless they follow the commodities. And what the commodity this one covers, and you can understand now, is silver. It has that exposure and it tracks the credit SISI of NASDAQ Silver Flows 106. Now, why this one becomes so interesting is because of the monthly income tied to the silver price behavior. It can be benefit in inflationary or hard asset cycles. And it's historically less correlated to a traditional equity income ETF. Now we look at the numbers here, and we talked about that 1, 2, 3 system. Well, number 1, the asset health. The assets under management are over $318 million. We look at the numbers, the dividend yield of 23.20%. Of course, we're going to show it, but we're not dialed into just the dividend yield. The fund growth is our number 2 of that NAV stability. The fund has grown at 36.51% for a total return of 70.96% over the past 12 months. Now, I got to say one thing. These numbers can all change. Dividend yields can change. The total return can change. The growth can change. As soon as the stock market opens, as soon as the stock market is running, things can change almost by the second. So I'm giving you the information that is dialed into in front of you up to January 17th of 2026. Now, the risk of all this is the commodity volatility. Income can fluctuate with the silver price marketing. And it's best for investors who want income with diversification away from stocks. When we look deeper into this fund, we check underneath the hood. You look at that 70.96% growth, the total return over 1 year. It has been rocketing. The income, the dividends, income volatility, it pays out again. We're going from something that's below about $1, $1.50, rocketing to $2, now up to $5.79 coming out here in January. When you look at the performance across the board, and this is why we look at these things, we're not looking at one great year that it's had, which it has. 1 year at 70.96%, but an average of 16.4 over 5 years. 10.52 over 10 years, and 4.25 since inception. So silver is getting a run currently going on. Our number 2, GLDI. And this one here is a similar in structure to the SLVO, but it's tied to gold instead of silver. Now, why does this one stand out? The gold exposure plus monthly income. One of the biggest problems that we have is when you buy gold and you're waiting for the price of gold to go up. It's not generating income. Well, with this system, you can get income along with that gold exposure. It often behaves differently when the equity-based income ETFs and creates a defensive income sleeve for many portfolios. When we take a look at the numbers again, the first one, $158 million under assets under management. So there's a lot of liquidity sitting here. The dividend yield of 16.68%, the fund growth of 14.17% for a total return of 35.42%. So when we take a look at that number 2, that NAV stability, again, consistently, continuously, that potential of it continuously rising up with the different pricing of gold. The gold exposure, it maintains at least 3% upside exposure to the gold's spot price. It has that income generation through monthly distributions from option premiums, and it's that defensive position that we talked about. When we look underneath the hood, that total return again, total return 35.42% over just the past 1 year. Very, very steep climb as gold prices continue to climb. We look at the performance over time. So we look at the first 1 month, year to date, which basically we only have 1 month in so far, 3.57%. 1 year, 35.42%. But then the 5-year, 10-year, and since inception are all very respectable numbers. And again, with this one, look at the dividends. The dividends have been rocketing and they are fluctuating, but you're now up to almost a $3 payment on a dividend. Now, will they hold? No, these things will always change. They're not guaranteed. We may go back down, but overall, you're looking at about $1 across the board, maintaining average. So again, why does GLDY, why does that thing stand out? Well, again, it's that low equity correlation and an income and defense combination. And that NAV stability, boy, it's focused right in. Look at the thing below. We put it here. GLDY's price versus gold's price, that's almost matching the two. And you're generating income from it. While the equities market has been down and then coming back up. So the income comes from option premiums on the commodity ETF. It's not tied to a single stock or option decay. It has a limited upside in strong gold rallies, and the income varies from month to month. So the income investor who wants this is stability and diversification. Our number 3 fund, MVRL, again comes out of E-Trax, and this is a monthly paying 1.5 times leverage on mortgages in the REITs. Now, this one gets overlooked many, many ways, and many investors avoid the leverage outreach of the program. But real estate fell out of favor after the mass hikes in pricing of the real estate and of interest rates. But what we look at here again is the hardcore numbers that we're dealing with. When we look at this, we have those, delivers that 1.5 quarterly compounded performance of mortgage REITs. It pays out monthly distributions. It has the exposure to the U.S. mortgage REITs, and it's generated that high dividend of 17.17%. But again, we're not focused on dividend. What we're focused on is total return. The fund has had a very strong growth, about 4.58%, giving us a total return of 27.04% over the past 12 months. Now, it has assets under management of about $15.11 million. So in a fund like this, not a bad number. Now we take a look at it, and remember our number 3 is the total returns, 27.04% total return. And you can see as it went through 2025, it was really related to what was happening with the interest rates and how the market, housing market went. And now the interest rates got cut, the thing rocketed up almost 7 percentage points at the end of the year for a great total return. But we look at this thing has some legs of 1 month up 13%. The year to date, which is only 18 days into this, is 11.69%. 1 year, 27.04. This fund came out in 2020. So we're just closing in on 5 years. Now, of course, the numbers are going to be lower, 0.47, because it didn't have a full 2020 year. I think it was June. So it was only a very short period of time. But since inception, 7.53% total performance. The dividends, you can see, they have, I call it the every other month spike. The thing has been spiking as mortgages and interest rates change and things go on. The more they get cycling through, they generate more income. So some of the things to look at. Now, why has the fund become so interesting is because of those monthly distributions from the mortgages. It's the real estate recovery potential that makes this one probably the biggest factor that we can see in those charts. And it has a strong return period when the REITs perform. Now, the interesting warning that we have on this one is the leverage will increase the volatility. So it's not a set it and forget it fund. You have to pay attention to that leverage because leverage works both ways. It can definitely go up and it can go down. And that's where we show you in the chart below, you see the baseline and you see what leverage can actually do. Now, for investors comfortable with volatility who want that monthly income and that growth potential, this fund falls right into play with what's happening with the economy as we know it today. That can change in matter of one speech. It can change in matter of a just bad press cycle, and always remember that. Fund number 4, KLIP, the Crane Shares KW Web Covered Call Strategy ETF. Now, this one's going to get into a little bit of an international flair and an international taste. Now, KLIP focuses on income generations tied to China's large cap exposure with the option strategy. So one of the big things I say up front, and you look at the graphic focus of this fund is 98% dialed into China. The top sectors are in that technology, the financial, and the consumer strategy of it. The income is generated from generating income through options-based strategies using covered call strategy and high momentum Chinese equities. So if you're not into an international portfolio, or if you want to see the second largest economy around, you have China open for it. Now, the dividend yield at 25.03% is very impressive. The fund growth, though, is down 2.16%. We see that with the April 2nd tariffs. We've seen that with the fights that we've had with China. You see the recovery, how quickly it came out of recovery. And it's all, understand, it's a global politics. It's a global piece. The volatility will come from news cycles across the board very easily. But the total return was impressed us again, 24.70% total return, and the fund has over $130 million under net assets. So when we take a look at the key factors again, and we talk at that total return at 24.70%, and we look at the breakdowns that we've had since inception, 12.15%. Dividends have kind of in 2025, what I call flattened out. They've smoothed out their dividend process, averaging right around that 60 cents per month. So why does this deserve such a good look? Is that monthly income. And the volatility creates those option premiums and has delivered solid income with consistent NAV. There's been no collapse in their NAV. It's been solid even through the good times and the bad times that we've had. Now, why is this one not under the radar? Is because of the China exposure scares many investors, and headlines keep most people away from it. But this is something that's been there for, doing some good quality work over a period of time. Some of the key risks of this is that global politic and the regulatory uncertainty. We get into a trade war. We get into a trade war with China. We get into different applications to it. It's going to cause the conflicts that we have. But the regulatory risks, policy changes that impact Chinese companies, the security regulations, and then, of course, currency risk, the yen's fluctuation, the exchange and controls. This is best suited for tactical income investors who want to understand regional risk. So number 5 is AIPI. Now, I've talked about this one a little bit in the past. This is from Rec Shares, is their AI Equity Premium Income ETF. Now, this is one that they put together that are aggressively going after iShares, artificial intelligence, and big data center ETFs. It's capturing long-term growth in the AI and data-driven innovations while generating monthly income. I personally think that this one is probably one of the sleepers of the group. Now, why is this one of interest? Well, AI exposure with income. That's a rare combination. Monthly distributions and growth-oriented underlying theme. Now, we look at the numbers. Of course, we're showing down 20% from the beginning of the year. But since April 2nd, it has been fairly flat and fairly steady right in that magic little niche. And actually down as we're into the beginning of 2026. I believe it's down at a lower point because everyone's worried about this AI boom and the data centers. But they're still investing big money into it and building them out. 38% dividend yield. Again, we don't watch dividend yield. The fund down 20%. Our total return is 20.96%. Assets under management, $408 million. So why the Nav Erosion has been more controlled? It's not a pure single stock covered call. It's a broader exposure, reducing the concentration risk. That's a big difference of just buying something particular on AI whim. This one has done it with that broader exposure across the board. We showed I'll call it the rocketing and the adjustments in the total return. We look at the 1 year and then the total since inception. So a lot of it questions, is this really a AI boom? Is this an AI, something wrong with AI? Or is it just point blank? Is it dialed into bad news cycles? We look at the distributions are paying out fairly smooth across the board. So the trade-off here is the income may be lower than ultra high yield ETFs, but it's still subject to that tech volatility. So if you put all your money into just an AI package, you're probably going to get bigger yield. But I don't think you're going to have a bigger total return across the board. This is for investors who really want exposure and income to the AI and data center market. Now, when I look at AIPI, we look at their key holdings is NVIDIA, Microsoft, Amazon, Meta, Alphabet. We're dealing with some major strong companies. It has that tech sector volatility, and it's growth linked with that potential. I just think this is the one that was probably underneath the radar the most. Now we're going to get to number 6, the QQQT, the Defiance NASDAQ 100 Targeted Income. Now there's a ton of NASDAQ funds out there, and you can add a Q to anything and have it towards the NASDAQ 100. And we're not going with the most popular one that we always talk about is QQQI. We're dialing in with something different, and that's going to be QQQT. This one targets the NASDAQ 100 exposure while balancing income with total return. And the reason why it stands out is that monthly income, and it's a less aggressive option strategy than some of the other ETFs out there. And what is that? Well, their conservative covered call strategy is only 25% option writing exposure. And this helps avoid NAV erosion. So 75% of the fund is trying to find natural growth, while 25% is in the option trying to generate that income. So we look at the chart again. Yeah, we're down 7.27%, but that's only from the April 2nd drop off. It's kind of recovered since then and holding well at that $17 price strategy. We look at QQQT's key factors. 14.11% total return. Distributions coming in very smoothly since the April drop off again, right around 30 cents a share. Now, the NASDAQ Income ETF often destroys the NAV, and QQQT avoids that trap. They try to continue with that point. So the yield may look modest compared to extreme income ETFs, but the total return can be stronger over time. And that's what we're showing here. So this one really is great for monthly investors without sacrificing growth and exposure. Now our 7th fund is from that Defiance again, the S&P 500 Target Income, the SPYT. Now this one provides the S&P 500 base income with a focus on preserving capital. Now, why is this one underappreciated? Because it doesn't have that real big flashy yield, and it doesn't market extreme income. Now, when we say not a flashy yield, 21.16 is a very strong number, but the total return is 12.93%. Because they've had a terrible April. That April 2nd drop off was huge and hurt the fund tremendously. But when you take a look at from June on, it has been a fairly stable account across the board. Why isn't it grown? Well, it's using that covered call strategy that on a portion of its holdings to generate the monthly income has capped the upside of the fund. Now, like I said, the 12.93%, you can see since that April 2nd, it's just been slowly climbing. And when we take a look at 1 year at 12.93, since inception, 14.57. Well, the monthly income, and this is why this thing fits the list, is the monthly income. Look at what it's done since April. It's stabilized itself right around about 30 cents per share per month. Now, again, dividends are not guaranteed, and these things can change on a matter of minutes as the stock market opens. But this one has historically been better NAV stability and total return focused over payout chasing. So this one's based really for a core income sleeve. The investors prioritizing long-term durability. This is a fund that I think really fits when we look at underneath that radar. So again, the best case use of this one with that stability focused long-term horizon and the balanced approach, This one is what you're going to have in a set it. I never like to use the set it, forget it, but basically it's a set it in your core package and let it run. So let's do the side-by-side comparison on a chart that we can all see. And here's the big takeaway. None of these funds are trying to win the yield race, even though we have some very, very impressive yields out there, 38, 25. Everything's really above that, about average of over 20%. But they're trying to aim for the pay consistent monthly income potential, and they avoid the consistent NAV decaying. And they deliver a very respectful total return. And that's what we're supposed to be focusing in on. We want to focus in on total returns. And when you look at it, everything is realistically a 20% or higher. Now the QQQT and the S&P 500 program, yes, they're going to be down a little bit. But that's part of the core of those, 14% and 12%. So the goal here is to maximize income at all costs. So these, they may disappoint, but that goal is to achieve maximum income. And the income and portfolio longevity is deserve that attention across the board. So our key takeaways, there is no perfect monthly ETF. But these funds are respect the capital, avoid aggressive income engineering, and quietly deliver strong results over time. If you're building a retirement income portfolio, these under-the-radar ETFs are worth understanding and developing and not chasing the advertised package, advertising everything out there. Now, again, guys, remember, this is not financial advice. This is primarily just an educational of how to look at different ETFs. So the final disclaimer, again, educational purposes only. I am not a financial guru. I'm not a financial licensed financial advisor. This presentation is for informational purposes only. Investor responsibility. Investors are solely responsible for conducting their own research and consulting with a qualified advisor before making investments. There are no endorsements here. None of these products are endorsed. There's no representation that I've made for any of these. And the risk warning, all investors carry risk, include potential losses. So make sure past performance does not indicate future results. That's why I tell you, research, research, research. Thanks, guys, for watching. Let me know in comments below what you think. If this is something that you like, and if you think these are strong funds under the radar.